6 Golden Rules for Young Investors. Samita is a final year student at Amity University. She inquires about the 6 golden guidelines for investing for young people. If you find yourself in the same scenario, Anita's advice should be followed. In this video, we will learn how the 6 golden laws of investing may completely transform your life. Anita. However, there are a few elements that are important to keep in mind that may keep you on track to reach your objectives. Investing doesn't have to be difficult or confusing. Even if you are a seasoned investor, it is worthwhile to evaluate these. No matter how disciplined you are, keep in mind that investing entails risk and you can still get back less than you invested. Nevertheless, whether you're a novice or seasoned investor, however, whether you're a newbie investor or an experienced one, adhering to certain principles can help you stay on the right track. Let's look at some of them. Pay attention to valuations. One major metric is very important to investors: valuation. In order to determine if an investment would be profitable, especially in the case of enterprise participation, the firm value is crucial. Investors do not want to pay any more than necessary for a company's earnings and potential for future growth. A company's value can be determined in a variety of ways. By examining the firm's progress over the past few years, you can determine the company's worth of listed companies using specific financial data. Based on this, you may create a plausible estimate for how the company might grow in the next years. In venture capital, that is, startup investments, company valuations are subject to a wider range of fluctuations as there are often no reliable financial figures. But here too, there are methods for determining the company valuation. This value is a direct indicator of whether and how much an investor should invest in a company. Save 10% of your income for retirement. Saving a portion of your income for retirement is one of the guideline principles for investing. To invest in retirement plans, try to set aside at least 10% of your income. You can benefit from compounding returns over time by getting started on your retirement savings early and continually contributing. You can get compounding returns over time by starting early and making regular contributions to these plans, which will guarantee a comfortable retirement. If, on the other hand, one of your goals is to save for an early retirement in 20 years, you would, usually speaking, be considerably limiting your chances if you just invested in term deposits. This is because growth markets like real estate and stocks have a history of outperforming other asset classes when evaluated over long periods of time, so any occasional short-term volatility will be offset by the long-term trend overall. It's important to take the time to determine your lifestyle objectives before establishing your investing strategy, because the key is to match your asset class to your time horizon. Invest early, invest regularly. It's true that starting early can offer your investments more time to flourish in the long run. However, you should wait to start investing until you can afford to do so. Before you start investing, follow these steps to organize your daily financial affairs. Keep some money in an emergency fund that you can access immediately. Having some cash on hand could make it easier for you to handle life's ups and downs without having to take money out of your assets. Don't ever invest with a credit card and pay off any debt you have. If the sum isn't paid off, interest and fees can quickly add up and are likely to outpace any investment gains you could achieve. You can start thinking about investing once you have your daily finances under control. You can then determine the amount of investment. Your chances of achieving your goals increases when you have your daily financial affairs in order. This provides you more time to invest frequently. A long-term, regular and early investing strategy is rewarded by the financial market. Even if the funds first seem little, start investing as soon as you can. It's important to be consistent since it helps your assets develop over time when you make regular contributions. In addition, when it comes to investing, Adopt a long-term viewpoint. Focus on the potential of your investment portfolio over the long term instead of making rash judgments based on short-term market swings. Think like an owner. Think like an owner, advises Chris Graff, RMB Capital's Co-Chief Investment Officer. Remember that you are investing not just in stocks, but in businesses as well. While many investors approach stocks like gambling, those stocks are supported by legitimate businesses. Stocks are a type of partial ownership in a firm, and when the company performs profitably or unprofitably over time, the stock is likely to move in the same manner. When investing, Christopher Miser, CEO of Vivaris Capital in La Jolla, California, advises being conscious of your motivations. Anita, Samita, make sure the management team is robust and supportive of shareholders' interests and that the business is in good financial and competitive position. Investors need patience. After identifying a good investment, the next step is waiting for the right time to get involved. Sometimes that can happen right away, and other times it can happen months or even years later. However, one must be prepared for it when the time comes. Don't jump on the next best opportunity. The market offers enough chances. When an opportunity is presented, the next question is how high the stakes are. Many investors make the error of making the biggest feasible investment in the profitable venture. Instead, the size of a stake should always be correlated with the potential reward and the associated risks. Diversifying risks. Investors should never place their capital in only one single asset. Rather, the risk of the portfolio should be as evenly distributed as feasible by investing in assets from various industries and with various risk or return ratios. This strategy is known as diversification. This is an investment tactic used to lower risk across the board. Investments having the least amount of connection between them are included in a diversified portfolio. This means that in the event of a risk, not all investments will lose value at the same time. For instance, you should invest all of your money in biotech stocks because the portfolio as a whole will lose value in the case of a sector crisis. Instead, make investments in stocks from a variety of economically distinct sectors. Diversification across asset types is also recommended. In order to do this, you must also invest in bonds, precious metals, call money, index funds, and stocks and equity funds. Since all investment markets will experience ups and downs, it makes much more sense to assess your risk tolerance and diversify across different asset classes and fund types in order to improve long-term performance and lessen the impact of downturns. Because you are not exposed to the unpredictability of any one market or asset, diversification is a wonderful approach to control investing risk and seek out higher rewards. End part. Making wise investment decisions involves both doing the right things and avoiding the incorrect ones. And in the midst of it all, it's crucial to control your emotions so you can inspire yourself to act morally even when it feels risky or unsafe to do so.